So I will basically speak about three financing strategies in Europe. One is the more mainstream de-risking approach. And we have, let's call it like a big green state. Lastly, I will present a sort of strategy that's merging these two approaches, or a progressive alternative, which I call progressive de-risking. First, we're going to talk about a little bit about the costs, the green investment gap in Europe. To be more specific, the research questions are, to what extent have Europe's policymakers succeeded in steering finance to green and other strategic investments through de-risking and non-de-risking fiscal schemes? What are some main policy alternatives to those currently pursued? Very briefly, some numbers. Corporate spending in Europe is below the Japanese and American counterparts, let's say. Industrial policy spending is much higher in China compared to Europe, according to one study. There's more to quantify these measures a little bit. China has invested 10 times more in solar supply capacity and also majority of net zero technologies with supply chains, while the US retains global leadership in digital innovation. And Europe's annual green investment gap is between 2 to 3% of GDP. This might sound as a big number, but see if it really is historically to other challenges faced. More specifically on the investment gap, first of all, we can say that the more we postpone investments today, the more costly it will be in the upcoming years. According to one study, if we're going to meet the 55% target to 2030, we need additional investments of 356 billion, or 2% of European GDP. Another study put this number to 400,000 billion euro, or 2.6% of GDP. And if we're going to reach the Repower EU and Green Deal objectives, the number is about 3%. And one think tank here provides some numbers towards where we need these investments, let's say. Mostly in buildings, transport. So de-risking is this major strategy the last 10 or so years in Europe. In times of austerity, de-risking aims to guide finance to green destinations instead of steering financial flows directly through fiscal means, let's say. This is achieved by public actors absorbing private risk, guarantees, public-private partnerships, and blended finance. De-risking aims to make green sector increasingly investable. Critics, such as Yanis Lafermos, who will speak after me, points to some problems with de-risking. It reinforces commodification, contributes to carbon lock-in, and undermines mission-oriented market-shaping approaches. De-risking is also exposed to regulatory capture, arbitrage, greenwashing, while it undermines policy steer and conditionalities on green investments. So the major two de-risking programs in the EU has been OEFSE, or the Juncker Plan, and the Invest EU, which has paper multipliers of 15. So, according to the European Investment Bank, a lot of private money have been stimulated through mostly guarantees. According to one study, the European Court of Auditors, among others, have criticized the limited additionality of EFSE, its inability to unlock projects that were too risky from a private finance perspective. InvestEU has limited policymakers' capacity to turn innovative projects with transformative potential into propositions for private and market-based finance. So it's mostly lower risk projects that seems to be more easy to crowd in, let's say. It goes on. So to save a little time, I jump to the big green state. So according to proponents of the big green state, going to argue that non-market mechanisms are needed to make large-scale investment for green transition possible. This is, among other things, due to the fact that green investments are relatively risky, volatile, and often not profitable asset class. And by the price drop, private investments in solar and wind are lacking. And Europe has a wind sector deficit of 74 billion euro. Quantified in fiscal terms, monetary terms. And Brett Christophers, in a recent book, he points to the fact that it should say 62%, but above, as in the mid-1980s, more than 60% of global electricity comes from fossils. It's pretty crazy. So in a way, the majority of electricity is fossil. And meanwhile, like, one can always ask how much money should come from the public sector or the private sector. And again, one think tank believes that a majority of the investment gap can be tapped by public sector money, actually. Again, historically, 2 to 3% can be a fairly small number. If we compare cost of course and the financial crisis. For example, according to two mainstream economists who are experts on history of financial crises, they point to the fact that public debt almost double when there's a major banking crisis. So, more specifically, how could a big green European state look like? You can see a much more larger scale on EU bonds, let's say. We can talk about a permanent investment fund. And some scholars have written on Europe-wide progressive taxation. People are also talking about development banks, be further leveraged. There are a lot of development banks around already. And also central bank policies, which I will not go into this presentation. But so one example of the EU bonds is the Recovery and Resilience Facility, raised almost €750 billion. We have around half a decade. Okay. And some member states have received grants and loans from the RF, corresponding to 9% of their GDP, while more richer states so far been awarded let's say 1%. But of course, in the global north, governments are less willing to spend in the first place, so often they are not so keen on. Some countries have not been so keen on asking for more money in the first place for developing their financial plans. But this number is way too short. Hence, Europe's green transition one should. There's some further arguments for a permanent EU bonds. Since there is a lack of fiscal space in many countries, collective EU bonds would be a good alternative than to change already complex fiscal framework of union, let's say. And also we can do an RRF type of facility or mechanism. It would be easier to carry out financing throughout Europe or equitable manner, let's say. People are talking about, mainstream economists are talking about the need of a safe asset, and the EU bonds provide such a safe asset. And lastly, interest rates would could potentially be fairly low, such instruments. I will only talk about this on taxation, but it's pretty easy to find some studies on people and European think tanks who has written on this issue. And if we like add these taxes to one another, we come up with pretty big numbers. So the European FTT, or financial transaction tax, was actually the European Commission's own idea 10 years ago, but failed to push through, unfortunately. Lastly, on the big green state, we can talk about development banks. They could be leveraged further, of course, issue their own bonds and equity. They actually take savings and deposits from their citizens, receive central bank financing, manage public pension or social security funds. Also, of course, they could accept new member states, receive new money from existing. Back in 2012, the European Investment Bank, its paid-in capital back was actually doubled. This could be done again, I can argue. And many people don't know this. I didn't know this, but the German financial system is to a large extent state-owned, like controlled by state entities, not least development. It's sort of an outlier, actually, Europe. So lastly, I'm going to speak a little bit about progressive de-risking, which could be argued to be like a hybrid between the green state and mainstream de-risking. And Eileen a lot of Mazzucato's work on this, raising. She writes that she sort of want to pull in both the private and the public sector in a revisionist manner. So we know from the past that public and private actors can come together and do extraordinary things. She points to the Apollo the Apollo spacecraft program. It's not only was an outcome of public investments, but also a lot of commercially minded investments. And her rhetoric is echoed by other industrial policy scholars such as Roderick, who says that rather than being a top-down command and control process where the state manages things, industrial policy can be more seen like a cooperation between government bureaucrats and firms. And similarly, some other European IP scholars write that industrial policy should be about institutionalized collaboration and dialogue between governments, the private sector, and civil society. So here we can see the difference between the big green state proponents that want to see a strong state pulling the strings, or like pushing the agenda. Progressive de-risking is sort of a more moderate form between mainstream de-risking and the So progressive de-riskers are not against de-risking per se, as long as public policy steer is maintained. So we shouldn't outsource all the decisions to the private sector, let's say. The state-capital relationship should be symbiotic rather than parasitic. risks and profits are shared evenly between the private and public sectors. And everyone works for a symbiotically common goal. Not a Kato's word. So more concretely, what do progressive de-risking lean on? Logically, we can point to the emission-based economy. It's progressive conditionalities. So more sticks, not only carrots, let's say. Development banks are actually key actors carrying out such programs. Also, some have written on the DARPA programs in the US. Maybe we could have European in here. There's a typo, so I just repeat what's said. So, starting with progressive conditionalities. Time is 4 minutes and 30 seconds, maybe.
It's like 5 minutes.
5 minutes. Cool. So, according to one IP scholar, conditionalities are rules, governance structures, benchmarks, and ownership agreements that align the preferences of state and corporate actors, thereby limiting the scope for rent-seeking behavior and strategic failures. And we talk about profits should be reinvested, not distributed to shareholders to a large extent. If firms are actually going to get subsidies, then they could, for example, be reinvested in R&D, worker training, and productive activities, etc. Profits could be shared between government and firms. So maybe we could give subsidies in exchange for equity, ownership, and stuff. The issue of directionality, meaning that only societally desirable goals are subsidized, self-evident perhaps. And also access. So if intellectual property rights will come out of subsidized programs, it should actually be more privatized but open to the general public. There's actually an Israeli scholar who has written on how the Israeli state managed to diffuse intellectual property in the Israeli industrial Iris Magor. It's pretty interesting. So, according to Stephanie Griffith-Jones, who I think could be characterized as a progressive de-risker, she writes that development banks can involve private finance in different ways. So you wouldn't hear this from a big green state, perhaps. And also, we can see some of these scholars have been sympathetic to de-risking programs over the last years. More in the working paper details, perhaps. Yes, that was actually what I wanted to share with you today. Some research questions I'm thinking about are possibly more forms of progressive de-risking. Are you skeptical about this phrase in the first place? Or does it sound plausible? In Europe, I talked about taxation and the RRF, etc. But you have other suggestions for more like what interesting fiscal, let's call it big green state policies already has been carried out already, or are there more varieties of de-risking? The mortgage de-risking, public sector de-risking, democratic de-risking. If you read the literature on de-risking, people have up with different names for this. And is all mainstream de-risking wrong, bad? Can we still use it to some extent? It's something like that. Thank you very much.